Hello everyone, this is Vio-là. Have you ever seen bankers serve the society? What would it be like if financial giants have to obey your comments and consider your feelings, just like a service industry? Stay tuned until the end because China's financial powerhouse is absolutely beyond your perception of finance. As we all know, China is a country where the state controls everything. Sometimes this has its advantages. For example, the state is able to force capitalists to channel their money back into social construction and to every ordinary people, making the Wall Street wolves work for your well-being. In China, the government is achieving finance serving everyone and becoming a financial powerhouse through these four methods. Finance is no longer a vampire, but rather a social activist. Can you believe it? Firstly, the state regulation. Almost all of China's banks are state-controlled. Even banks established for private enterprises in their early days have been forcibly injected with state capital in recent years. The state is the major shareholder of all banks, holding absolute power. Many foreign banks entering China have been functionally reduced to mainly marketing functions. Take Standard Chartered or HSBC, for example. They can't make any important decision. The Chinese government actually has a somewhat adversarial relationship with capitalists. It conducts regular inspections of financial institutions to check if they are truly operating according to government regulations and whether they're making unreasonable excessive profits. Financial institutions are also forced to establish internal disciplinary inspection, compliance, and risk control departments. The Chief Compliance Officer typically holds veto power over internal decisions. It's like the government and the institutions working in a coordination, similar to an HR department reporting to NGO about the boss discriminating against women. Of course, the effectiveness in implementation is certainly compromised. The National Financial Regulatory Administration, that's China's equivalent of the FED, is not responsible for monetary policy, but focuses solely on regulating behavior, separating and decentralizing execution and supervision powers. When systematic risks arise, such as the recent downturn in China's real estate market, where many companies faced funding cracks, the government temporarily bailing out certain large real estate enterprises through state-owned companies to prevent their bosses from fleeing with all the money. Based on past experience, the state also requires real estate companies to prioritize ensuring the delivery of houses to ordinary individual buyers. Secondly, adherence to the central bank system under the centralized unified leadership of the Party Central Committee. China's central bank is the People's Bank of China. The meaning is clear from its name alone. The BOC is responsible for formulating national monetary policy, aiming to maintain currency stability, not to print money immoderately. Currency stability helps avoid inflation, prevents the widening of wealth gap through its invisible wealth redistribution mechanism, and stops wealth from concentrating among capitalists. Besides formulating monetary policy, the BOC also bears the responsibility of being the lender of last resort. The lender of last resort acts as the ultimate backstop in the financial system. When a commercial bank faces a bankrupt, it can seek help from the central bank, and it may step in to provide emergency funding. This system helps good banks overcome temporary difficulties. Essentially, the central bank uses national credit to guarantee market credit, injecting confidence into the entire market. While providing a safety network for commercial banks, it also maximizes the protection of retail investors' interests. In execution, the BOC embodies characteristics such as large extent of intervention, diversified in financial tools, and high speed of reflection. Chinese people generally don't have to worry about suffering huge losses on their bank savings due to structural financial crisis. The third point is gradual and orderly opening up to foreign capital. As everyone knows, many transactions and financial activities in China are not free and require complex, lengthy approval processes. This is because our financial system's capacity to withstand risks is relatively weak. Once international financial markets fluctuate, like when the FED raises interest rates, large-scale capital outflows could occur, impacting foreign exchange reserves and the RMB exchange rate, affecting the operations of import and export enterprises. Conversely, if the FED cut rates, a short-term influx of hot money could lead to stock market and real estate bubbles. A gradual opening up approach can effectively filter out short-term speculative capital, prioritize the introduction of long-term allocation capital, align with the country's sound development patterns, and serve the interests of the majority of the people. Furthermore, Mondel's impossible trinity theory states that a country can only simultaneously achieve at most 2 out of the 3 goals: monetary autonomy, free capital mobility, and a stable exchange rate. For China, monetary policy must serve domestic employment and inflation targets. And to maintain monetary autonomy, it is necessary to limit capital mobility and the exchange rate to a certain extent. More importantly, the Chinese government's idea has always been finance serves the real economy, aiming to prevent the economy from diverging from reality to emptiness, although I don't think this has been perfectly avoided. History shows that many countries experienced manufacturing sector shrinkage due to overly rapid opening up. If financial opening is too fast, resources will flow towards the high-return virtual economy, squeezing the manufacturing sector. China's approach is finance provides whatever the industry needs. For instance, to support import and export trade, it opened up letter of credit services. Then, to meet corporate overseas expansion needs, it opened up long-term capital from the global. Each step of opening up is intended to meet the real economy's needs. China's financial system, under strong state regulation, has seen its dynamic impacted to some extent. As a giant country, China's financial development actually lags behind most developed countries. For example, our financial products lack of variety. The banking sector accounts for 90% of total financial institution assets, limiting the efficiency of supporting technological innovation and SMEs. Our financial instruments have relatively low end. Financial institutions suffer from severe homogenization. The securities industry accounts for less than 4%, and comprehensive service capabilities are weak. Cross-border financial service capabilities seriously lag behind the pace of corporate overseas expansion. Chinese banks have few overseas branches, and many transactions still rely on the US dollar as an intermediary, etc., etc. Fortunately, since 1978, we have been slowly but continuously strengthening opening up and have the successful experiences of many other countries to learn from. The fourth point is the 5 major chapters of finance proposed in the national strategy: technology, green, inclusive, pension, and digital finance. Technology finance aims to guide capital towards early-stage, small, long-term, and hard-tech enterprises, making finance the engine for technological process. Green finance serves the dual carbon goals, guiding funds towards energy conservation, environmental protection, clean energy, and so on, forcing the transformation of high-energy consuming industries. Inclusive finance focuses on weak links in people's livelihoods, serving micro-businesses, farmers, new urban residents, and other long-tail groups, enabling financial services to cover a wider population, rather than circulating only among the wealthy, thus contributing to common prosperity. Pension finance addresses China's aging population problem, meeting diverse elderly care needs and ensuring good living standards of the elderly through investigation and development of commercial pension insurance. Digital finance aims to improve financial service efficiency. As I mentioned before, China's financial development is actually quite backward, so it's even more necessary to use technologies like big data and AI to enhance risk control capabilities and service efficiency. At the same time, the strong regulatory system for finance that the country has built over a long time also ensures that national strategic guidelines can be effectively implemented. I believe taking money away from capitalists and returning it to social development and the construction of people's livelihoods is something very counterintuitive, since capitalists are actually those who with power to make the rules. Common prosperity is also like that. When people hold decision-making power and wealth, it's hard for them to consider the remaining 80% of the population. But China is miraculously walking on a path towards common prosperity. It's hard not to attribute this to the fact that many among the decision makers truly love its people. This might also be a unique achievement of collectivism that is difficult to replicate elsewhere. So that's all for today. Thank you for watching till the end. If you like my video, subscribe my channel and I'll show you more about the real and new China.